Let's now let's welcome in a very special guest. Ashwini Agarwal, founder of Demeter Advisors, joins us right now on the show with his thoughts on how is he seeing the landscape. Ashwini, good talking to you. We've been trying to catch up for a while. Well, it's good for it to happen this way as well. How are you approaching this year end, Ashwini? Because it's a packed next 45 days. An FOMC meet, FI holiday season, and then new allocations, a Trump presidency starting, earnings season, budget. Oh my God.
Morning, Niraj. Yeah, you said it. I mean, the next couple of months are going to be indeed very busy on the news flow. And markets have done really well over the last 1 year. So obviously, it makes sense to be a little bit skeptical and cautious as you approach all these big events. My sense is that, US remains the Pied Piper of investor sentiment for the time being. And so long as the US, party continues, there is going to be no let up for India or for investor sentiment broader across the globe. Having said this, the Trump administration is still to sort of figure out what it's going to do. So there have been a lot of what they've been saying. Some of it makes sense, some of it kind of is scary. And finally, we'll have to see what gets rolled out in terms of policy. On the financial side in India, so there are two issues. One is rates, and the other is what happens in the budget. On the rates, with the new RBI governor in place, let's see, how he takes up the challenge of liquidity, which has been plaguing the Indian money markets for a little bit. I think inflation is kind of, a little bit on the softer side. So I'm hoping that he can cut rates whenever the opportunity next arises. On the budget, I'm just waiting. I hope there are no further changes to capital gains taxes, but we'll have to wait and see what happens. So yeah, it's interesting. Lastly, on corporate earnings, which is another point that you raised, I'm hoping that the December quarter and March quarter will see some revival as opposed to a very disappointing first half as the government spending picks up and the marriage season, which has been very, very tepid in the first half, picks up a little bit, but we have to wait and see.
Ashwini, FICCI, some other corporates are all saying that things are bouncing back. Now, from the lows of Q2, it is probably a foregone conclusion that things will bounce back, right? Is that good enough to spur earnings enough to make people or to surprise people on the upside with regards to earnings? Or is it just a bounce back that was waiting to happen because Q2 was just so bad?
Interesting point, Neeraj. But think about it this way. 2024 has been a year of several disappointments that the market has kind of just ignored. Okay. You've had higher rates for longer. At the start of the year, I might have said in several of our conversations that I expect the rates to come off. They haven't come off. You had a general election outcome that didn't meet our expectations. You've had corporate earnings which are much slower than expected. Okay, and the market doesn't seem to care. So what is the market celebrating? Okay, the answer to that puzzle lies in the fact that today, if you look at post-tax returns on equity versus debt, the difference is so large that the domestic investor has no choice but to park money in equities. And my sense is that, with financial savings being roughly 12% of GDP, give or take, and equities being some 17-18% direct and indirect together, you have enough of a flow to support the market no matter what. This is a very dangerous situation, honestly, because the bubble will keep getting larger and larger, and it's only a big accident that can prevent things from getting completely stretched. Think about the 401k revolution in the US. Think about what happened to Japan, before it finally crashed and burned for 30 years. I mean, valuation can keep going up. I think the only solace that I have is that there is enough equity paper, some of it very high quality, which is coming in and making sure that some of this money gets deployed in the right places. So that could be something that holds the market back. So otherwise, I think that corporate earnings, yeah, they might be a little bit better than September quarter, or they might be a little bit worse than expectations. Who knows? But the reality is that market is not reacting to earnings anymore.
Yeah, well, yeah, that's also true. What's the narrative is being rewarded quite strongly, Ashwini, as we've seen, for example, with Dixon today. Though I'm not saying it's just narrative, it's a company that's performed tremendously. But the limited point I'm trying to make via this point is that somehow, when the narrative looks very strong, valuations for a very long period of time are being given the leeway that, hey, go on. I mean, what's happening with these green energy transition companies or EMS companies or some such? I mean, I know you are a GARP investor, right? But you're seeing these companies perform for 2, 3, 4 years on, earnings growth continues. How do you convince yourself, Ashwini, that it's okay to miss these opportunities? If you miss them, I'm not saying you have. I'm presuming that you would not have bet onto some crazy valuations.
No, I don't. I mean, triple digit PE numbers are very scary. Okay, we've seen this in the past, whether it was IT in 2020, whether it was 2000, whether it was infrastructure in 2008, whether it was the very high quality FMCG stocks, through the decade of 2010 through till about 2021. And then it was the Zomato Nyakas of the world in 21, and so on and so forth. So the reality is that if you buy a stock at 150 PE or 120 PE or whatever it is, the companies will find it very, very difficult to meet investor expectations on a 3 to 5 year basis. So short term, we don't know. Short term, narratives can take hold and stock prices can do what they want. If you sold all IT stocks in the middle of 1999, you look very stupid for 9 months, and then you look very smart for the next 20 years. So it depends on what you want to do. So the way I think about it is that if it doesn't make sense to me, I won't do it. And it's okay if I don't make as much money as somebody next door. That's fine. But it's important to be thoughtful about what one does and to do what one is comfortable with. And in that space, there are plenty of opportunities, even though the market is very strong. There are many companies which have been suffering because of inventory correction, for example, in a lot of manufactured products. So you think about chemical companies. A lot of chemical companies have seen compression in margins, have seen lower revenues, partly because prices of the products have corrected, and partly because the end markets were oversupplied in the aftermath of COVID stocking binge, if I would call it. And those things will return to normal. And I think there's an opportunity there. I think there's opportunity in pharmaceuticals still. And I think, on a bottom-up basis, there are some companies in India which are doing reasonably well, where you can, make a bet that they've invested ahead of the cycle, and those investments will come to fruition over the next 2 to 3 years, and they'll make money for you. So, my point is that I look for those opportunities, and I'm happy to let some of these narratives pass. I don't own Dixon, and I wish Dixon the best. I hope they and their shareholders do really well, but it just doesn't fit my investment style. That's all.
Yeah, of course, of course. Point well noted, Ashwini. Yeah, but yeah, it's an interesting one. So, okay, so two more questions. One is on that bucket, which is manufacturing, not very well performing in the last 2, 3 years. You mentioned chemicals. There is this feeling, Ashwini, that if China would give some bit of stimulus, then some of the chemical products which they are dumping across the world, including India, might get used back home for them. That eases the pressure on the chemical companies in India and hopefully brings earnings starting Jan, Feb, March 2025. Is that a plausible argument? Part one. Part two, it's been a 3-year cycle, nearly 3-year cycle of flatline performance to underperformance for most chemical names. Does it change, and why so?
Okay. Great questions, both of them. So the first one is speculative. Okay. The answer to the first one is speculative in the sense that I really don't know what's happening in China, and I doubt very much that anybody else does. Okay. So what will finally happen there, I don't know. But I do know for a fact that given what's going on a geopolitical basis, most buyers of chemicals from China are looking for diversification, are looking for secure supplies outside of China in addition to China. And whether or not China's surplus stocks get depleted or get redirected internally or not, I think there is an opportunity for Indian companies to step up and supply products to the rest of the world. Why chemical companies have underperformed for the last 3 years is a combination of two things. One, because the COVID stocking binge led to an inordinate expansion of margins, and the narrative took hold where valuations went completely berserk for several of the stocks. The subsequent destocking and disappointing earnings have really hurt stock prices. So, coming back to the point we were discussing earlier, when you pay triple digit P's, or not even triple digit, if you pay 50, 60, 80 times multiples, which the market was paying in 2021, 22 on the back of stellar earnings for a lot of the chemical stocks. I think you are running into the danger that if earnings disappoint, you have both earnings contraction as well as PE contraction, which is what has happened to chemical companies. But you had restocking, and then now you had destocking, and now I think going ahead you have a very normal cycle coming up. So you have a normal cycle coming up. You have probably earnings that are depressed. You have P's that are not so depressed, but if earnings catch up, then I think, there's room to make money. Are you going to make sort of multi-baggers there? Answer is no. But will you make 15, 20% annualized return? I think you will. And I think that's a very reasonable return to look for given where the market is.
Got it. Last couple of questions. A sector that is a sector that has run a part of its cycle, Ashwini, real estate. And yeah. For our viewers, I mean, if you go onto our digital channel, you will see this fantastic conversation on a show that we did call Insight, where Ashwini Agarwal was a guest along with a real estate company in Gurgaon or NCR. And Ashwini, some of it has turned out just the way maybe you had thought of as well. I would love to know whether you believe this current ongoing real estate cycle continues, or are this spate of QIPs that some of the companies have done giving a sense that maybe there is an issue in the quantum of sales, etc., that is happening or thereabouts. So real estate companies, whether NCR based, of course, and the rest of the country, and then does it have implications for the real estate ancillaries?
So my sense, Niraj, is that while there has been a lot of front page news coverage on how egregiously priced real estate has become and how hundreds of crores are being spent on apartment spaces by the well-heeled. I think the reality is that we went through a 10-year down cycle in real estate. Okay. And I think, the stock market returns, as well as a lot of the benefits from entrepreneurship, they are being put to work in terms of people wanting to upgrade their homes. And I don't think the cycle is ending right away. In my opinion, real estate cycles tend to be long. A bull cycle tends to be at least 3 to 5 years long, and a bear cycle can be 7 to 10 years long. And I would say that we are kind of somewhere in the middle. And in the middle of the cycle, is it possible that stock prices and demand takes a little bit of a pause? Yes, that's possible. But have I given up on real estate? I don't think so. I mean, the company in question that you referred to continues to be a part of my portfolio, and we'll wait and see how it turns. I mean, investors should do their own homework. I'm not recommending anything at all while investing, but I think as a cycle, we are still somewhere in the mid cycle. I don't think we are at the fag end of it just yet. So I think that one will stay as a theme for a little while.
We have a minute on the show, Ashwini. Ancillaries, could you come, because those haven't quite performed, the plywood companies, etc., etc. Do they start performing or not quite?
I think B2, a lot of these ancillaries are B2B businesses. I don't know why they're considered as B2C businesses. And I think that's again a situation of narrative over reality. I mean, I don't know what would have been, applied in my office or at my home. It's the reality is the contractor or the carpenter decides. And these are B2B businesses, and therefore the valuations, again, had run ahead of themselves, is my view. I think businesses will do well. Valuations, I think, will remain moderate.
Wow. Interesting points. So much to glean from some of the answers that you give, Ashwini. So thank you so much for all of that. And season's greetings to you. May you have a great holiday if you're taking one, or may you have a great time in Bombay because the weather is certainly perked up. So either ways, have a fabulous next fortnight.
Thank you, Neeraj. Thank you, and wishing all your viewers and all of you at NDTV a very Merry Christmas and a Happy New Year.
Thank you, and wish you and yours the same, Ashwini. Really appreciate your time.